All right, folks, welcome back to the Property Couch podcast. And we got an amazing episode for you today. We have got our annual look into the future with our 2025 property outlook. Ben, what do we cover in this episode?
Well, it's all about reviewing 2024, our predictions that we made there and how accurate we were. And then obviously we're setting up for a case for what's going to happen in 2025 and some of our predictions as well, Bryce.
What's going to happen in 2025, folks? Stick around. Let's rip into the show.
Welcome to the Property Couch, where each week you get to listen to two of Australia's leading experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, co-host of Escape from the City on the ABC, and partner of Empower Wealth Advisory. Ben Kingsley, chair of Property Investors Council of Australia and the founder of Empower Wealth Advisory, named the 2018 and 2019 Property Advisory Firm of the Year. Stay tuned as they bring you the insider's guide to property, finance, and money management.
All right, folks, welcome back to the Property Couch podcast. And as I say to you every week, welcome back to you too, mate.
Well, mate, it's good to be side by side. It must be such an important episode that we've dragged you all the way up from Torquay.
Yes.
From the sunny Torquay into the studio.
Well, I'd argue that you don't invite me into the studio anymore, mate. But that's another debate for another day. But it's nice to be here with you because
huge show.
You're right. It is a very important show that we do. It's our annual sort of
outlook and predictions.
Dust off the crystal ball. But normally we do it at the beginning of February, but we've pushed it back to the end of the February just to allow us to get a little bit extra data, a little bit extra read, and also just to get a bit of a sense on such an important announcement that the RBA made recently as with respect to interest rates. So folks, we are looking forward to today. We've got a fair bit to unpack.
We've got a heap. Lots of data today. It's a graph and data. It's a technical show today.
It is a technical show. So that's a good point that you raised, Ben. So for anyone who's listening to this on audio only, we are going to do our very best to sort of project the imagery of graphs and text to you. But for ultimate viewing, you'd want to be looking either on Spotify or YouTube, Ben, where you can actually be a part of the visuals. But let's rip into what's an important show. And just to set the scene for someone who might be experiencing our outlook for the very first time, Ben, we're not just going to sit here and go around the grounds at a headline generalized level. What we're going to do is we like to actually give the meat and potatoes underneath some of the data and some of the thesis and the thought process that we actually go through so that we can arrive at some of our conclusions. And for those of you that are critiquing us, yes, we are going to have a look 12 months ago. What did we say? What happened? Was there any gap? Yes, we are actually going to be talking about that as well. So the more transparent we can be, obviously, the better we can serve our community. But before we get into the meat and potatoes of the show, Ben, my Mindset Minute theme today, I think, is leaning into what we're doing today. But as you know, Ben, I recently went to the US to go to a conference. And one of the key ideas that I came away with that was, I think, is relevant to our community, and for those of us looking to do something that a lot of people are not prepared to do. So,
yes,
which is invest in property, which is not the path most traveled, it's the path least traveled. But here's a story and an analogy that I came across. You cannot explain to a turtle a giraffe's decision, right? You cannot explain to a turtle a giraffe's decision. So let that land.
Yep.
So when you're built to be tall, your strength lies in maintaining a perspective that few people can see from down below. Okay?
Yep,
got it. Hence the giraffe and the turtle. So giraffes are designed to be above the crowd. They stand tall. Their heads are held high, providing them with that vantage point that hopefully that we're going to provide today, Ben. So here we are claiming that we're giraffes, and I think that comes from the reps in the game for us. So, but if they let their heads droop for too long, they risk losing that unique view and missing out on the broader picture of their surroundings. So that's setting the scene. Now, the way that this was presented to me, Ben, was that hearts have these massive, oversized heart.
Giraffes. Yep.
Giraffe. Yep. What did I say?
Hearts have these
massive hearts. You know, giraffes have these massive hearts.
Yep.
Ideally to pump the blood straight up that long neck to get up to the top, right?
Makes sense.
And the way it was presented is if the giraffe actually bends down and keeps their head below their heart level, it's actually not good for them and they can pass out. Well, I went and researched, Ben, and that's actually not true, which is a shame because it makes the story so good the way that it was delivered to me. So, but I'm thinking, I checked that. So, but much in the same way that we allow ourselves to get bogged down by trivial or lose sight of, our high-reaching goals, that's when we compromise our very nature. So our strength and advantage comes from the ability to see far beyond the immediate and to keep our eyes on that horizon rather than keeping it down at ground level. So hang in with me here, folks. So embrace your inherent stature, stay focused, keep your head held high, and never trade your elevated perspective for short-term comfort. So where does that fit into today? I think that largely what we're about to say, Ben, for the remainder of this show is, I'm going to say it up front, it's irrelevant. Because for anyone who actually aspires to do what we do, Ben, and play a decades game, what we're about to talk about is just noise but what it will help people do is make the best decision on where they can enter so that they can play a much longer game.
Yeah, no, I like it. I like where you're going with that.
But here's the punchline. Ready?
Yeah, go for it.
There's no greater waste of time than justifying your actions to people who have a life you don't want. Right? So here we are. So if you're a property investor and you've got people around you that are trying to get you to justify the decisions that you're making, but they have a life that you don't want, chances are that is the greatest waste of time that you've got. So here we go, folks. As we set up
take that energy and ingest it into something else. I really like that.
So as we set up for 2025 Property Outlook today, I want you to all have this. I want you to have the perspective of a giraffe, being able to see things that other people can't see, and that's what our community has been, because we've got an aspiring Australian community.
Agreed.
But also, there is no greater waste of time than justifying your decisions to people who have a life you don't want. And we have a surprise.
This is surprise.
So we didn't know about this. Wow.
Oh, jeez.
Wow. Holy smokes.
Oh,
wow.
Okay.
So gather around, folks. Gather around.
Come in.
So just
come in so everyone can actually see what's going on.
Just to explain what is going on to the folks that are listening to this, we've just had a crowd of our team just join us, and if you can focus in on that, you'll see that we have got a 10 years. So Ben,
now I know why everyone wanted to start on time, because there's this surprise party that was happening in the background.
Thank you. Just got a gift from the Stig, and we've got Dave who joined us. We've got Sam who's from our mortgage team. We've got
Steph
from our buyers agency team. So thank you.
Wow, happy 10 years.
Happy 10
years.
Thank
you very much.
Congratulations.
Thank you.
I just joined in. Okay. No, you have to open this now.
Oh, okay. Bryce, you have to open that. I'll hold this. You open
that.
Don't
move that away.
Oh, okay. We'll move that away.
All right. Okay. All right.
Here we go.
Get Ivis in.
Come on. Come on, Stig. Okay, here we go.
So let's open
She's still not in the shop. Get in the shop, please. Thank you.
There we go. There we go. Is it going to jump out at us?
It probably is. Oh,
yeah.
There we go. The butterflies. Oh, there we go. Get them out of there. Oh,
thank you. Look at that.
Oh, wow.
That's exciting.
That is super cool.
So for those of you that are playing at home, they've just delivered us with a box, and it's got a really nice treat in it. And these butterflies came out of it, but it's got some really nostalgic photos in there. Which
that is super cool.
Which is incredible.
Oh, wow.
That's not the best part. We do have a video message for both.
Ben, Bryce, congratulations.
Welcome to the Property Couch. They bring you the insider's guide to property, finance and money management.
Oh my goodness, 10 years.
Beautiful, Jane.
What an achievement.
A decade of valuable insights, inspiring stories, amazing guests that we've had too. Was I on 3 times?
It's been a privilege to be a small part of your show over the years. You guys are legit. You're the original gangsters, well respected. And
not only have you pioneered it for the property area and led to incredible growth at Empower, but it's actually just empowered the whole podcast sort of community across the country.
You've done a great job educating and informing your listeners about property, making them aware of the cowboys and the shonks out there.
Look, needless to say, you have helped so many people navigate the property world and all things money.
And I just have to say to Bryce and Ben, thank you so much for the integrity and the information that you've brought to everyday Australians in lifting the understanding and the knowledge base of how to invest in property.
You've been doing an awesome job and making a positive impact on everyday Aussies' lives like myself.
You guys do an amazing job with all the content you provide.
It's been inspirational to see clients that you've helped over the years to invest into property, secure some of their future, and also the help throughout the property industry that you've given over that time.
Read the books, watch the shows, listen to the podcasts.
You should be so proud of what you've achieved over this decade.
I am super proud of you too.
Well done again.
Keep up the good work.
And I wish you all the best and hopefully another
10 years of you two sitting pretty on that couch.
Thanks for your generosity, Bryce and Ben. We love you.
And we can't wait for the next 10 years.
Congratulations.
10 years, can you believe it?
Mate, until next week.
Knowledge isn't praying, but only if you stumbled on that.
See you next week, folks.
Just ease up on the AFL chat this season, eh?
Oh, wow.
Wowee.
Oh, thank you for...
Yes, that's very cool.
Very cool. Thank you very much. I'll put that in here. Thank you.
Thanks very much. And thank you to the beautiful crew who've helped make this happen.
Yeah, 10 years.
Well, I didn't expect that at all.
No.
Thank you for all of that work done in the background. Everyone, that's crazy.
Wow. So I'm not sure we were expecting that, Ben, and I'm not sure how the edit will go on that, but that was amazing.
Party hats.
That was really cool. So we should talk to that very quickly. So, folks, if you've been on the journey with us for the last 10 years, thank you for allowing Ben and I this opportunity to speak into people's lives and do something that is our life's work, something that we're very, very excited about. And I think as I reflect on 10 years, Ben, the biggest thing that I think that the Property Couch platform has provided me, and I know from conversations with you, but I won't speak for you, it's allowed us to just continually stay sharp and look for opportunities to keep getting better and better at what we know and how we understand our craft and how we understand the game, so that we are able to serve our community in a way that we want to, that allows us to provide hopefully information that helps people get ahead in life.
Mate, I'm a little bit speechless. Obviously, it's beautiful that the team recognised what we do. We got confetti and everything all over the floor. I mean, it took me a while to work out what my purpose in life was, but I love to help people and I love to build things that help people. And so I think from that point of view, the work that we do, the advocacy work that we also do, hopefully it's helping. And for those people who have been on the journey with us for that period of time, thank you very, very much. And for those who are new to the journey, hopefully the education and information that we share with you is experiential in terms of it's testing your thinking, but it's also proven in terms of the evidence-based information that we're also providing you in terms of making those decisions that you do. So hopefully it's allowing to challenge you with your own critical thinking and then ultimately taking action in terms of what we expect you to be able to achieve if you put your mind to it.
Well said. So again, thank you for allowing that self-indulgence there for that. For those people who just turned up to find out what's happening in 2025.
Yes. I've got to reset now. Reset the mind.
And of course, we say it all the time, but the Property Couch looks like a duo, but it's actually a trio with Stiggy, who's been here from the start, and obviously she was the pioneer of making that happen. So,
yes,
mate. So thank you to everyone. Hey, so we set it up, Ben, that you've got to have the perspective of a giraffe. You got to make sure that you're not justifying your actions to anyone who has a life that you don't want. So let's really rip into what I think is a very, very important outlook for this particular year for a lot of people who want to change their lives in the next 12 months. So
let's look at 2024. We'll recap on the predictions that we said. So let's just start firstly by just sort of recapping the capital cities. So we saw Canberra had negative growth of 0.4. Darwin had a small amount of growth of 0.8. Hobart was negative 0.6. Perth was obviously the standout state in terms of price performance at 19.1% growth off the back of a year prior that was also strong. Adelaide 13.1, Brisbane 11.2, Melbourne went backwards by 3%, and Sydney scraped out a 2.3% gain over that period. So again, what Bryce was saying earlier, we're not really interested in terms of the Australian property market because that's irrelevant. The Australian property market is made up of hundreds and hundreds of sub-markets. And obviously that's why we're interested in sort of talking about the capital city markets rather than the broader Australian property market. Yes, we know Australian market grew by 4.9%, but no one owns a property in the Australian market. You're owning properties within locations, and it's those properties within those locations that are ultimately going to drive the land value, which is ultimately what you'll get in terms of long-term capital growth.
And it shows on that slide there too, Ben, because if you actually look at headline level there, you've got combined capitals at 6% and combined regionals at 4.5%.
Yep.
It actually doesn't tell the story that Perth did 19.1 and Melbourne did -3. So
exactly.
That's why for 10 years, we've been trying to say to people that headlines help no one because it's actually markets within markets.
So that's our focus. We're really going to sort of drill down in terms of what's happening in those particular markets. And that sort of is going to lead us into those conversations. Now, last year we said that the biggest market that was more likely to perform well was going to be those affordable markets. And the reason why we made that justification is because of the market interference by governments and the regulators. So by APRA having a 3% throttle in terms of buffer rate on lending and ultimately higher interest rates, also reducing borrowing power, you ultimately were going to see activity in that lower end. So the pressure was always going to be on those more affordable locations. And this chart really clearly illustrates that in terms of looking at the quartiles. So we can see there in Brisbane, Adelaide and Perth, the strongest quartiles, and this is the change only in the last 3 months. And so if you extrapolate that out over that time period, you'll actually see that is the strongest performing market has been that budget level market. Now, traditionally, what we would also say, if it was a free open market, normally you see the growth occurring in the higher property value markets and then that trickling down in terms of that. So that is one of the observations that we want to share for you in terms of 2025 is, again, and this comes back to the logical thinking. If that is the traditional way in which property prices will grow, there's got to be a point where the value of those properties at that lower level don't justify their existence if these property prices in the premium level, in the status locations, in those premium locations, that will always be that case. So in 2025, one of the things that's going to be more challenging is where does the market go and will it have the same sort of level of growth given that differential has shrunk a bit because those bottom level markets are coming up. And by way of example, if we actually have a look at the performance of that lower end market, what we saw was that lower quartile grew by 9.4% compared to the bottom quartile, the top quartile, which only grew by 1.5%.
And so equally on the states where they actually declined in value, you'll see that first quartile declined the least.
Yes, and so normally what you'll see is in a classic sort of standard market without any market manipulation, which gives us these unintended consequences, you would normally see the higher value markets move forward and then ultimately then middle markets and then the lower markets catching up. And then what you normally then see is a little bit more volatility in those higher end markets because at the end of the day, we are talking in the millions of dollars. And so when things are going well for businesses and share prices are going well, there's a lot of demand for those. But obviously when economic downturns occur, those markets are a little bit more susceptible in terms of range and volatility compared to the bottom end of the market. Now that rings true for our capital cities. That doesn't ring true for our regional market or our lifestyle markets. Those regional markets and lifestyle markets, which aren't close to a capital city centre, they also have a lot of volatility, and that's driven by the short-term demand and supply, which can sometimes have irrational versus rational behaviour. So hang around till later when we talk about that, when we think about one of our big tips for today's episode, which we'll share with you later in the show around, do you want to be a price taker versus do you want to be a price maker? So let's talk about the assumptions that we did make for 2024 in the base case. So the base case we had was for 3 rate cuts, and obviously we saw 0 in terms of that period. Now that was obviously off the back of inflation remaining stickier, The unemployment rate, which we also predicted to move into 4.3 to 4.5 range, did not move at all. So we have seen a really strong employment market. We've seen a lot of growth in employment in this country, an enormous number of jobs, more jobs than we've ever seen in Australia before. Now, that was off the back of government spending. So what we have seen is record levels of spending by governments, and that has created this higher employment level than we've seen before. So that was really important. What we also saw is consumer spending. So per capita consumer spending definitely declined because obviously the amount of household income that we had was reduced by the higher interest rates for those households that had mortgages. Around 50% of Australian households had that. We didn't see a recession, so we got that right. And in terms of the inflation level returning to with a 3 in front of the data feed there, we didn't see that. And so we've now just seen that in the December quarter where we saw inflation move inside that band, but we still have trim mean inflation. So that's the core inflation still sitting outside that band. But over the last 6 months, that has moved to 2.7%. So, that's exactly why we saw the rate cut that we saw in February from the RBA. In terms of the derailers, we did have some predictions around, moving off that base case. The biggest one was domestic politics and government spending. So we had a lot of elections, and normally during election times, we see a lot of government spending. So we've got record spending across the government, and which we'll talk about more about. So that was, again, one of the things that elevated the unemployment story. And that has obviously been the reason why we've had inflation remaining stickier than what we predicted. That said, we still saw those better performing markets and those markets that we did predict that would do quite well, such as Perth, Adelaide, Brisbane. They did do well. The markets that we said were challenged, which was Melbourne, Sydney did better than we expected, again, off the back of strong employment, but also those other markets such as Hobart and Canberra also didn't perform as we predicted as well as that. So,
and stick around, folks, because we're actually going to talk to that Melbourne story in a little bit around why at a headline level there was potential for it to increase in value, and in fact, in reality, it didn't. So stick around for that, because I think that's a really important observation from the last 12 months. And I think for our community and for our audience, I think you're going to be really interested to see why we think that actually came to fruition.
Yeah, so what we now want to do is then we'll always start with macro, and it's really important. Remember, when we talk about investing in the decades, the number one consideration is economic activity. Now, we can give you a demonstration of how volatile house prices and an economy can be by just looking at the Whyalla story that we've just seen recently. So the Whyalla steel mills and production that we see in Whyalla, it's a one-trick pony town. So 3,000 people were employed directly and indirectly in terms of that. So we've seen a government bailout of over $2.3 billion, if my numbers are correct. And so if that hadn't have happened, and if that big steel operation, steel mill, had have closed down, that town and subsequently their property prices, their land values, population would have moved away because they can't stay. There's no jobs there.
Yeah.
And so they need that money to live. And so that is a classic microcosm example of why economic activity and continued growth in economic activity for any area that you buy underpins long-term land values.
With layers of human interest and human behaviour.
Yeah. Well,
because you've just demonstrated that economic activity alone isn't sustainable, because you take away that the mining activity. There is no human interest. There is no human behaviour. Therefore, it will fall away.
That's right. And so, Whyalla, I can still go out and fish and do all those stuff, but they're the lifestyle drivers that I get the privilege of doing based on the fact that I'm earning that income from those steel operations. So that's just an example. So we always start with a macro. And so what we're going to do is work through a series of macro indicators that just allow you to be more informed. The number one indicator, and if you've been listening and watching us for the period of time, is always inflation. Okay, inflation destroys living standards. It destroys disposable income. It does all of those things because it makes the cost of money higher and the cost of buying things higher as well. So your money just doesn't stretch as far. So our predictions around inflation is we'll continue to see a decline, but the speed in which inflation will come down from here is the challenge, right? So what we've got to basically see is how quickly will that inflation fall within the 2 to 3% band range that the ABA is targeting. So they're targeting 2.5, the midpoint of that band range. So that's what we've got to be focusing on. And how inflation comes down, well, inflation is the measurement of the cost of goods and services. So what you've got to always remember when it comes to price and how things are priced are these variables, your input costs. And unfortunately in Australia, energy costs continue to rise higher and higher and higher. Hence why we get these government rebates and subsidies, because that's happening in the household and that's about buying your votes. But in terms of what's happening in business, we are still incredibly uneconomical and uncompetitive on a global standard when it comes to our energy costs. So that is a high cost. It's continuing to grow. And so that's putting challenges in terms of input price costs. Then the cost of human capital. So ultimately, if we are trying to spend money and earn money and things are costing more, we want a wage rise, because obviously the money that we get just doesn't buy the same amount of goods and services that it used to. So there's an expectation that we get higher wages. Then you've got productivity. So if you're going to pay high wages, we expect the output, we expect the output to be higher
on that.
Because the trade-off is then obviously, if the business has got to make a decision in terms of passing on those costs. Now, if demand is soft, they won't really have that luxury of being able to pass on those costs. So what they will then do is reduce their operating costs by reducing the number of human capital that they have, working. So that's when we start to see that unemployment story lift. And that's usually what happens when we try and put the brakes on the economy by raising the cash rate higher and making the cost of money higher. So, and then there's a flow-on effect in a broader economy. It's like, okay, if I lose my job and you use it, and there's just job losses all around, that obviously quells that demand, and that's how you get that sluggish economic activity. Now, we are coming off the backside of that after those 13 rate rises as part of that, and that leads into what we talk about in terms of the cash rate and interest rate. So currently we saw a cut from the RBA in February this month, last week. And effectively what we saw there was a 25 basis point cut. So the cash rate's now at 4.1%. So what we need to continue to keep understanding is we've made the assumption, our base case is that there's going to be another 2 rate cuts this year in terms of what we're looking at. And so that will play into, how much affordability, what sort of borrowing power changes does that mean? And will that drive a spike in sentiment and activity as part of that particular story? Then we move on to the unemployment story. And Bryce, what's our predictions for unemployment?
That it will actually slightly get worse.
Yep.
And that's it. That's important, and it sounds harsh for anyone that's listening to that. But for the RBA to get confidence around inflation not returning to previous levels based on dropping in interest rates, they need to have some confidence around that unemployment will have that slight tick up. So we're obviously predicting that might happen this year as well.
Because if that is ticking up, it's showing that businesses are hurting and ultimately price pressure is on the downside. And so there's a bit of debate and argument about whether that they can continue to move inflation lower with the high levels of employment that we've currently got. So that's a debate that's currently going on between the RBA and a lot of economists who are trying to predict what happens next there.
Because there needs to be that tension, right? Because if they're just going to drop, because there's a difference between dropping interest rates, which is reducing in expense, versus interest rates going up as well. So what remains to be seen is if people are getting more money in their pockets as a result of a reduction in expense rather than an increase in wage, what impact that would have on people. But ultimately, if you're getting a few extra bob in your pocket because of these interest rate rises, you'd like to think as an econ that people will put that towards increasing their buffers, put it towards reducing their mortgage. But we know from reality, and we've seen it too many times over the experience of these interest rate rises, that people are still spending. So hopefully some of that will go towards buffers. But we think that consumer spending will definitely pick up in 2025 as on the back of what we just talked about, lower borrowing costs. In some cases, increased wages growth. And then if you've got this is a big one, and it's something you and I talked about a fair bit before we hit record, is you've got a population base that is moving through a phase of going into retirement, getting access to super, having lump sums in some cases. And that particular cohort didn't give a rip about interest rates
Well,
during the
they
increase.
lost some of their interest income.
Yeah,
So,
but they hadn't had a mortgage to pay, because if
Correct.
they'd been diligent through their working life, that was paid off. So that largely was only impacting them. So as interest rates go up, they're going, this is great because we're getting more return on our money that's in the bank. And then
That's right.
as more people move into that phase, so that'll obviously contribute to consumer spending in 2025 as well.
And let me just sort of highlight the importance of why lower inflation is so important. So if we said inflation was moving at 2% per annum, over 3 years, that 2% would mean the cost of that same item would be 6%, right? 2% on 2%. So it's 6% higher to pay for that same good or service, right? What if it's 3%? That goes to 9%. And then what if it was 4%? Well, that goes to 12%. So the idea here is to try and say, so if it only went at sort of 2.5% or 3% over a couple of years, it's double the cost. And so that's why it's so dangerous to have inflation in the economy running at a higher level. So the Reserve Bank are committed wholly to get that rate down. So it just basically means standard of living and our money stretches further. Okay, so we've done inflation leading into cash rate, leading into employment. And if we do have strong employment, we expect consumer spending to also be quite robust throughout the course of this year. And if people are spending, that means usually we need human capital, those jobs to be able to service those people in terms of buying those goods and services. What we also expect to see is wage growth will be steady at around 3 to 3.5%. But what we do expect in terms of that wage growth is that we aren't seeing this sort of wage price spiral, and that the risk that could happen in regards to that. So they've got to keep an eye on that, but it's not certainly showing its head, because that's what we were talking before about. If we expect inflation to be really high, then we always expect that our wages have got to go higher and higher and higher, and that kills businesses and kills economies. So that's an important message there. The other big part about this is we want business to drive economic growth. We really don't like it when governments are driving economic growth, because that means that they're spending a lot of taxpayer money to be able to do that. Now, we do believe that infrastructure, roads and rail and those sort of productivity aspects are really important. But
until you see the number.
Yeah, how much of it you do over a short period of time puts a lot of pressure in regards to that. So we are expecting business investment to be steady. And that, again, is off the back of, if we can keep those gains, in terms of those employment gains at the early 4s, then reality is business will still be roughly confident there'll be enough demand for them to keep investing at the levels that they invest. Then the final one is government spending. Right now, we are coming into an election. That election will occur before the end of May. This is a federal election. We've seen on the weekend that both parties have now just guaranteed another $9 billion of spending when it comes to bulk billing and Medicare services. Now, again, health services are important. This is about not leaving people behind. So I understand the reason, but it's also a vote getter, right? So where Labor is trying to play this is that they are the caretakers of Medicare, and they're going to argue that the Liberals are going to take all of those services away from them. So it is all about buying votes. Make no mistake about that, because they want to stay in power, because they believe that their principles and values of what they want to share with the community, if they can't do anything if they're not in power. Same with the Liberals, don't get me wrong. They've got their agenda in terms of how the world needs to look, and they believe that obviously a stronger economy is the way in which you grow prosperity for all. So we're going to see definitely increase in spending, which ultimately means we're going to see deficits and huge amounts of debt. For the first time ever in a period of time, we've committed to over $1 trillion worth of spending across all governments. So that's state, federal. And so that's an enormous number. That's a huge milestone.
That's 1,000 billion.
That's 1,000 billion. And that's gone into infrastructure, health and essential services, defence. Now, the interest bill on that is expected to double by 2027, 2028. So when the government does that, they borrow money. Some of it's on fixed term interest rate. But as those interest rates and they roll over and refinance that debt, we're expecting that debt to double. And that then puts pressure on the government purse to do any further spending unless they try and find some savings. And part of those savings is potentially trying to reduce the size of government. But we just don't have that appetite. And again, This is what happens in an established and a wealthy economy. That's a democracy, is people get to vote based on how much they're going to get in return, and that's basically how it works.
Maybe they need Elon to come over here, mate.
Well, maybe a bit of Doge wouldn't be a bad thing for us in terms of finding some efficiencies.
Just cut off the payments.
Consumer sentiment now. So remember, demand is driven in the short term by activity, and activity is usually driven by sentiment. So how confident am I in terms of X is going to happen, and that's going to be sustainable over a period of time? So we're looking now at the Westpac and Melbourne Institute consumer sentiment. And the two lines that we want to look at here is a time to buy a dwelling. And remembering anything above 100% is optimistic. Anything below 100% is basically pessimistic. And so we can still see here more broadly a reading of 87.8 in February. Now that was pre the interest rate movement, but the house price expectation index is running at 142.3. What does it tell you?
So Ben, I'm feeling a little pessimistic about going now, but I've got this eternal optimism that it's going to keep going up in value.
Yeah, so the reason why people are telling you it's a difficult time to buy a house is because for the bulk of people, housing affordability is challenging.
Yeah.
I mean, we all have expectations of the great Australian dream of having our home, and we have expectations of where we want to live. And so when those expectations don't meet reality, we have a pessimistic view of that. And that's exactly what shows up in the data here. But what we also have, and this is a superpower for house prices long-term growth, is that everyone expects house prices to keep growing. Like there's this sort of built-in DNA in us that sort of says, now,
when you get some people from Europe who come over and they see that Australians have this innate DNA built in, that it's going to continue to go, you can see the back of their eyes. They might have been in Ireland, or they might have been in some of these markets where property prices have fallen out. But I think one of the things that Australians can always, there's always been a backstory and a history that they've gone up in value. So that builds belief and momentum. But the other thing is, we just have this superpower in this country that we punch out of our weight division based on where we rank in economy, based on the population we have, largely because we're sovereign. People want to come here.
Yes.
We've got great lifestyle. We've got access to food. We've got resources. So when someone's trying to compare us to other places around the world where they go, we used to have that eternal optimism too, and I can tell you a story about when our property prices tanked, they just don't have the same conditions that we have here, where we're it's like a bath that's filling and it just keeps on spilling over the sides.
We are a young democracy, 220 years old.
Mm-hmm.
In terms of other countries and especially Europe, those societies and civilizations have been there for a couple of thousand years. So it really is important to understand that even though that's built into our psychology, it's not guaranteed. And so, again, the thing that guarantees it is economic activity and prosperity off the back of that economic activity, which ultimately builds asset value and growth and generational wealth. And then that's recycled in as part of this particular story.
And the other part is we don't want to build inland, Ben. I've just driven across across the US, and there's just these population centres when there's no ocean in sight, and yet in Australia we do it to a small extent, but we don't do it en masse.
Yeah, so that's a beautiful segue into, again, the underlying sustainable, thing that really does make sure that it's not a voting machine, but it's a weighing machine in terms of long-term capital appreciation in property, is the economic performance of those particular states and territories. So what we wanted to do is just showcase exactly what's happening across the broader market. So looking at all our capital states and territories, we've got a little snapshot here that you'll see on your screen. And effectively, this is CommSec's State of the States, and they're ranking each of those states in terms of the best economies and the best performing states. And you can see there, based on the ranking here, that Western Australia is number one. Now, we did predict that. We said that their economic fundamentals are so good and so much better than any other state and territory right now. They've got literally no debt, about $38 billion worth of debt, considering when you're talking about Victoria's peak debt's going to be about $280 billion. It's just chalk and cheese. They're running a surplus, which means that basically they don't have to put any extra pressure on taxes. We'll see in a minute, basically, the jobs growth that's happening over there. They've got an energy advantage. They've got a proximity to Asia advantage. So they have, it really would require an incompetent economic management government to stuff up just how good the Western Australia situation is going to be over the next couple of decades.
So what I'm hearing you say, Ben, is West is best.
West is best at the moment, Bryce. The Ducks have lined up for the West, and it is going to be really, really good.
And it's important to know that there is some sustainability in that too, because they previously have had a spike based on the mining boom previously, and then they've spent a decade in the doldrums. But I think what we're observing is the price correction is actually just bringing it back to the level. And then because of all of the things that you just said, meaning that state still has that economic engine that's powering and that's over and above just the rocks that they sell to China. There's more becoming more of an advanced and mature metropolis. Therefore, that's what gives you the confidence. But obviously, people who have invested in that market in the last 36 months have seen rapid growth. So that's over. But in terms of sustainable growth going forward, there's still reason to be optimistic there.
Oh, and a lot of people got that wrong. And a lot of other commentators said it's a cyclical type of market. And we said, no, we think this has absolutely changed. And have a look at it. It's got the highest number per capita of self-employed and businesses. So it's got a huge number of small businesses, which in these times would normally do quite well. So you're going to also see second highest level of disposable income. So in terms of affordability, and that's obviously why rents are a little bit higher as well, right? Because rents can be pushed up a little bit higher because people can afford them in that particular market. So you've got those types of fundamentals, as well as, again, attracting the living standards over there are wonderful, like in terms of coastal living and affordable coastal living compared to obviously the East Coast as well. So there's a good reason why Western Australia is well positioned. We'll talk about where they are in their price cycle for property later on in the show, but that just gives you. Then you've got Adelaide and you've got Queensland, who are also second position. So if you start to have a look at, we're not going to go through all these data points. So if you're watching it on the screen, you can study these data points yourself, but you can see we've got economic growth, retail spending, equipment investment, which is business investment. We've got employment growth, construction work, population growth, housing, finance, and dwelling starts. So you can see all the things going on there. Now, again, that's the economic story. Look at just the dwelling starts for WA, 69.4% up. So there is a building boom going on in WA. That is going to increase some supply. So that's where you'll start to see that equilibrium come into play in terms of demand and supply. But the fundamentals for Western Australia, you're probably not going to see this cyclical bounce that we've always seen out of that particular market.
Well, the thing about that chart too is where WA isn't number one, it only misses by a shade as well.
Yes, exactly.
But you've got WA, you've got South Australia, and you've got Queensland that are strong in that chart. And then if you look historically what they did in the last 12 months, it kind of makes sense. So it's giving our community the understanding of the correlation between economic engines and performance of property, right? And hopefully that's the takeaway here.
And there's a couple of other things. If you read these reports in detail, you'll also know that the way in which they measure these particular readings, it disadvantages the Northern Territory and it disadvantages the Tasmanian marketplaces just on the sheer size and scale of the other markets in terms of how they do their seasonality and their weightings. So when you read those reports, you can also see that, say, take for example, Darwin and Western and Northern Territory. They've got a lot of investment going back into there. They've got a new government that's really trying to stimulate investment and activity and population growth into that market. So that's also good. The reason why Victoria is also sitting at number 4 is purely off the back of the government spending program. This big, massive infrastructure program, it's keeping jobs at a reasonable level. Now, bearing in mind, Victoria has now fallen to the lowest or the highest unemployment rate in the country. That's off the back of also new migrants who are arriving here as well, who are trying to get into the workforce. But we've seen Victoria go from 1 and 2 several years ago, now falling down off the back of the fact that most of their investment is, and most of their jobs are being created through government spending. And that government spending is eventually going to fall away as part of that. So let's just do a quick wrap in terms of what we see from a state-by-state point of view. So for the good for New South Wales, relative population growth. The bad is the amount of construction work, dwelling starts, and housing affordability. Construction work and dwelling starts, that's good for lower demand and higher pressure. For Victoria, Bryce?
Well, the good is definitely population, and you think about the multicultural opportunity that exists here. We're getting lots of people wanting to come here, which is good. Construction's been pretty good, the big build, but government's running out of money, Ben, so that's not
that's right.
The bad is clearly debt. Our daily interest bill is off the charts, and that needs to be addressed. And then that will have a flow-on effect for jobs in terms of if the government's not putting all the infrastructure spend in because they're running out of money, where will those people go?
We've got the highest number of self-employed and small businesses failing in Victoria compared to any other state in Australia.
So they'll probably end up going into residential construction. So Queensland, the good is housing finance, employment growth, population growth. Who doesn't want to go there for lifestyle, Ben? Their dwelling starts is great, and that has a huge multiplier for the economy. And their general economic growth, as we've just went through before, Ben, equals second.
Yeah,
that's pretty good. The bad is business investment or equipment investment is not as great as it could be. And as a result of people jumping over the border, Ben,
and
paying for
growth,
prices, that means has a flow-on effect for housing affordability, even if we could say that word, affordability.
Now, we've also spoken about how good Western Australia's construction, surplus budget, low debt, population growth, jobs growth, dwelling starts, housing affordability is their bad. For South Australia, equipment investment strong, housing finance, dwelling starts, general economic growth more broadly, again, supports economic growth in that state. The bad, retail spending and housing affordability. In terms of Tassie, equipment spending and finance, but you had to go pretty hard to find those two as positives. Then the bad is population growth.
So and that's important. Population growth is always, that's why there's some people who made some money trading that market previously, but investing in the market long term, that's the biggest problem for Hobart.
Very good. Debt levels, economic activity. So government debt levels, again, employment growth, construction, dwelling starts. In the Northern Territory, equipment, strong exports, really good strong exports out of there in terms of gas and also protein, so all of their meat exports and so forth. Housing affordability and CPI inflation. So inflation's running very, very low in the Northern Territory because the economic activity is softer. A bad is employment story. There's not a lot of jobs going around up there, construction work, population growth, and dwelling starts. So that just gives you a nice little snapshot in terms of what's happening when it comes to that story. Now, one of the final two measures we want to look at is population movement. So population movement, not necessarily population growth, but movement then determines that population growth. So let's zoom in and take a look at, the story when it comes to population movement. So you can see here we've got greater capital city and then rest of state population growth between 2011 and 2021 in terms of what's happening. But the one we want to spend the most time focusing on is the latest data that we've got in terms of that population movement. And we'll have another look at this in the middle of the year, but we can see here that we've got a natural increase in New South Wales, so that's births, but then we've got a net interstate migration. So that's negative for New South Wales. And then you've got net overseas migration, which is positive into New South Wales. In terms of natural increase in Victoria is positive, and net overseas migration is also very, very strong.
But interstate, it's negligible.
It's negligible. It's just negative. It's slightly positive in terms of people moving to Victoria. Then you've got Queensland, which has a strong story in terms of...
That's where everyone's gone.
Everyone's moving to Queensland. So you can see there, obviously, positive increases in natural increase, net interstate migration, and overall net overseas migration. South Australia is negligible when it comes to the internal movements of people, but has picked up a little bit of net overseas migration. Western Australia. Now, when you look at these numbers here and you say, okay, 140,000 into New South Wales, about 130,000 into Victoria, you've picked up about 60, 70,000 net into Western Australia. But on a per capita ratio basis, that's about 2.9%, if my memory serves me correctly, versus, the percentage in New South Wales is about
plus 1. They're getting interstate, plus they're getting the natural increase on top of that.
So the sheer stock available, so whether you go and move in with friends and family or go and rent or buy something brand new, and there's just not the stock size available to you compared to your bigger capital cities. So that's why we're seeing pressure when it comes to supply for both new housing and also rental accommodation in Western Australia. Then you've got Tassie. You can see they're actually got no positive population growth, very, very small. You've got very, very small into Northern Territory, and then the same sort of thing, very, very small into the ACT. Again, context, they are very, very small population centres. They don't even fall in to the top 15 population centres across Australia in terms of those numbers. So that just gives you a bit of an idea. Now, the one thing you also want to be thinking about if we lift our eyes into the macro long term is you want to have a look at the population spread. So all I'm just doing here is giving you a teaser to sort of say, this is the population growth story since 1911 through to 1961, through to 2001, through to 2021. And so you can see the population spread. And then what you want to be doing is doing this research into the particular cities that you're going to invest in, because this is the risk in terms of going into some of the regional towns. If the population spread is in people over 65, they're not adding any productivity to the economy. They're only adding it through health services and maybe the golf courses and
some
the lifestyle spending, but they're not generating new income. They're spending their savings, and so that doesn't drive strong economic growth and activity for that particular town centre. So if those lifestyle centres, you've got to have a look and make sure that there's a new wave of young people moving into those towns if you're thinking about the longevity and the economic activity that's going to support the house prices over the next couple of decades, not necessarily over the next 12 to 18 months.
It's why you want to combine regional and coastal.
Correct. And, or, like when we talk about regional, we talk about commutable cities to the big employment centres. The other thing that you also need to be aware of when you're starting to frame up your concepts about where you want to buy is household size. And we talk about, in terms of the composition of the household. So we can see all the way back in 1910, 4.5 people per household. Now we're down to 2.5 people per household. And the other trend, and these are good news trends when it comes to future demand for housing, right? And so that supports future price growth over the long term. The other one here, which is clearly indicating that as well, is the proportion of people who are single that is also growing. So single person households is also growing. So that puts further demand when it comes to further housing stock that we need to accommodate the demand generally in the marketplace for housing in Australia.
And it reinforces the point that we have housing scarcity, but we don't have bedroom scarcity.
Correct.
Sometimes you can have, to that point there, you'll see a smaller number of people in a household. Well, they could have 2 or 3 empty rooms in a house. So it's not a bedroom scarcity issue we've got. It's just a dwelling scarcity issue.
Beautiful. Okay, so that wraps up our macro piece. So we're now going to share with you our base case scenario. So when Bryce and I and our buyers agents, we get together every 4 to 6 weeks in our investment committee, and we are constantly looking at this base case. And we're basically challenging ourselves in terms of what are those macro pieces, and then we go into the micro level. So we go into the clusters in terms of local government areas and particular suburbs and then streets in those. So all of that is driven though in terms of what are the locations that we're going to buy in for growth, what are the suburbs that we're going to buy in for yield, and a combination of those and those types of locations. And we think of those things through 2 lenses, through the premium lens, which is driven by human activity and human behavior. And so that's the status and everything like that. And also the entry-level lenses. So when we need to find those entry-level price points to get in the market, that's how we're basically building out our location selections. And then we go into those markets to find the pockets that we want to start buying in. So here are our base case assumptions in terms of that. So we believe that trimmed core mean inflation, so that's the one that really matters for the RBA, will move into that 2 to 3 target bandwidth at around 2.7 by the end of the year. It's just going to take a little bit longer than we'd expect. And that means that instead of getting 3 rate cuts, an additional 3, we're only going to get 2 more. We're predicting the next one in May, but it's probably, that might be a little bit optimistic. It may be then July, and then the third one just before Christmas. So if the economy is a little bit sluggish, hitting everyone in November, leading into Black Friday sales and consumer spending, and then into the Christmas spending period, that's a nice time to drop a rate cut to get the economy moving back in. We're also making an assumption that Labor will win the federal election with a minority government. So they will form government with the Greens, and that in itself is potentially quite difficult for the property market when it comes to investment. So we believe that there will be continued government spending because that's what Labor and the Greens want to do. They want to throw more money into the economy. And that will be focused on the housing problem for owner-occupiers and renters as opposed to investors. So that's something we've got to be mindful of in terms of that macro-prudential interference in the market. If we think long-term again, but remember, this is the assumptions in terms of what might happen in the short-term period. In terms of population growth, we think that'll move back down to its long-term average of around 250 to 300,000. Now, for context, people, in 2022, 2023, we had 739,000 new arrivals into the country.
Let that land, folks.
And then 2023, 24. Now, remember, a lot of people left during COVID because we couldn't support them. They didn't get any of the government finances if they weren't a citizen. And so then approximately 667,000 new arrivals in the 23, 24 period. So that will move back down. And one of the things we talked about earlier, the student accommodation and student university, so studying international students in terms of coming into the Australian market, that is also dropped significantly. And our data suggests, especially here in Victoria and Melbourne in particular, that's resulted in 20 to 30,000, maybe even 40,000 less demand for accommodation for international students just here in Melbourne. And that has led to, obviously, the rental yields softening in Melbourne compared to our prediction last year. Because if they had been here, the vacancy rates in Victoria would have been catastrophic.
Now, those numbers for the previous couple of years in terms of the population growth, that should give existing property investors a lot of encouragement. Because if you think about what happens when people come to this country, typically they rent first, they find their feet, they find the location, they cluster around the cultures.
Mm-hmm.
But then once they've found their feet, they're obviously wanting to then branch out and buy their first property. So it's not like the ones that are coming to the shores this year are going to impact it. It's got to have a look in the rear vision mirror and see the ones that have come from the last 1 and 2 years. And as you can see, well, for those of you watching, but for those of you listening, that's a significant number of people who are actually going to be continually adding to the demand pool for property as well. So that should encourage you if you are holding property for the long term, as couches should be been.
I think that's a really nice segue into also then thinking about, well, that's our base case. And so then if you think about what other things could potentially impact that. So let's assume the Liberal Party win the federal election and also form minority government. Well, if they are able to pass their legislation, they've got 2 pieces of legislation which will impact demand in the short term. The first one is you'll be able to access super and take $50,000 out of your super for a deposit for a home. Now, remember, a deposit is the biggest challenge in terms of getting into a market where housing prices are a lot higher than they are. So that's the biggest challenge for first home buyers, deposit. So we'll see Liberal allowing access to that. In addition to that, they've also brought in a policy position around APRA and the lending buffers. So they want to reduce the serviceability buffer from 3% downwards. That will obviously increase borrowing power, and that again could help first home buyers and investors, depending on how they set those mechanics in terms of that. So that actually will have a positive impact on demand if the Liberal Party get into government. In terms of what you'll also see is less government spending. They've made a commitment to that, and you'll probably see less employment in terms of the public sector versus the private sector. So they're the sort of main derailers that we see, sticky inflation. So, part of slowing the economy down could see higher unemployment, and that's obviously good to bring interest rates down as well. Global economy, obviously we've got the big ones going on at the moment, which is really about tariffs and also about, geopolitical sensitivities and wars that are going on and how they will play themselves out. So we know historically tariffs aren't good for global economic growth. So, it may be good for one country over another, but not necessarily good over the longer term for broader economic growth and prosperity across the globe. And then obviously we've got the geopolitical wars, Russia, Ukraine, and also what's happening in the Middle East with Palestine and Israel. So we're to see how those things play out. In terms of now bringing it down a layer to the market risk, the governments obviously, when they bring in populist policies which effectively don't allow a market to operate freely, you have unintended consequences. And that's a good lesson in terms of what we can learn. And so I want to just take a little side note here, and I think this is hopefully one of the big takeaways. When you do this type of work that Bryce and I get to do, you actually think more about what's happened in the past than what you think is going to happen in the future. And some of your best lessons will come from the knowledge that you gain from the last couple of years that you've seen happen. And so let's give you an example of Victoria. We've told you that the prices have fallen by 3%. Now, we know you've just seen positive population growth. You've seen the economy going okay, record spending, record infrastructure, lots of jobs. So why is it that the Victorian property prices actually went backwards? And so you dig a little deeper into that, and you also find out a couple of other things. You find out that it's investors who have been abandoning the current Victorian market. So around 26,000 property investors have sold up, and there are now 26,000 less properties available for rent in Victoria based on the bonds data. Now, what you also see off the back of that is that has meant that there's been less demand. And so that has actually led to an increase where Victoria is leading the way in Australia in terms of the number of first home buyers coming into the market. So it can tell you a story in the short term, all right? In the short term, that if you manipulate demand, you will get a correction in terms of the audience of who's buying. And ultimately, at some point in time, the investors will accept what's going on and that additional demand will potentially come into the market. But that's something that we all should learn, that when you do implement macro-prudential regulation, when you introduce 133 rental reforms, when you increase property taxes to the highest level of any government in Australia, you are going to disincentivize investment in the short term. And that's what's playing out. So that has led to an opening for first home buyers. It's led to higher stock for them to choose from, less buyer demand, which meant that they've been able to negotiate better prices, slightly lower from the original peak. And so we as investors, and we in terms of thinking about what happens over the next 2 or 3 decades, we don't care too much for that, only that because we know that eventually it gets adjusted for. But in the short term, that's the type of impact that you're going to get as part of that story.
And for a lot of people listening to that, there's a couple of things. One, there's an opportunity, right? Because it's probably bottomed. We can tell from the talking to our team on the ground that there is a hell of a lot of energy going on into the Victorian marketplace. And at some point in time, they'll realise that actually was what happened, and they'll probably find some way of incentivising investors back. Like they could start by dropping land tax.
Yes,
but ultimately, and it's a message for some of our audience and some of our community who are actually clients who have actually had Melbourne properties, and they've been watching over the last 3 years, seeing some of these headlines and some of the valuations. It's like, yep, that's fine, because if you're holding it for a longer period of time, this will just be one of those sort of blips on a graph that ultimately your starting point and your ending point is much higher than your starting point. But you've obviously gone through a bit of a journey to get there. But whether or not there's an opportunity that exists in Melbourne, we can tell you that there's anecdotal evidence already that is starting to be the case.
Yeah, so what we're seeing here, and we'll go through the other points, and I'll come back and talk to what I call enthusiastic amateurs who are coming into the marketplace now with not a lot of fundamental long-term analysis. They're coming in with, Melbourne looks affordable, let's come into that market. So it's headline. They're not, and so they are creating this level of demand that we didn't expect to come for at least another year or two. We thought people might be a little bit more educated in terms of that. But that is creating, and at the end of the day, if that's the sentiment shift that occurs, doesn't matter how good an analyst you are, and whether it's still demand, and if they're coming in with checkbooks to buy at a price point that they want to buy at, that is going to move the value, even if the fundamentals don't necessarily stack up.
The point isn't to judge whether people want oranges or not. The point is to notice that people want oranges.
Yeah, they're buying oranges. So I think that is an important point, because Victoria still has a transitional problem that they've got to deal with, and that's going to happen over the next few years. And that is when the government stops investing the level of money that they are, where are those construction jobs going to go? And because ultimately you can't have this massive build. We've got construction going on everywhere in Melbourne in terms of roads and metros and everything else that's going on.
Stations.
Yeah, and now they want to build it as a city loop. Right? That's only for jobs for unions, right? Don't think that that's got any economic value at all. It's an absolute white elephant. It's a disgrace. But I won't go there. In terms of, I did go there. But in terms of what we need to do is move that workforce into housing construction. So, because if we still have the population growth, this is maybe one way in which Victoria will trade out of their debt level. And that is moving all of those workers that are working on construction into residential construction. and high-rise construction. That is the only way I see where we're not going to have, we're going to be taxed out of our existence because we've got this level of debt down here. But just be mindful of those enthusiastic amateurs who are potentially in those particular markets. Now, I promised you earlier in the show that I'd give you another tip, and here is this tip here. Bryce and I last year, and we've talked about this now for probably the last 10 years, in terms of owner-occupiers are the long-term price makers and investors are the price takers.
Should be the price
Should be the price takers. It should never be the other way around.
Avoid that at your peril.
And so this is one of the biggest messages we've got through you. So I'll give it to you halfway through the show. You don't want to be investing in a marketplace where it's everyone who's investing, or 10 out of the 12 buyers are investors. You do not want to be buying in that marketplace, with one exception and one only, that it has to be a large capital city.
Or access to, commutable to.
Yeah, or commutable to. They are the exceptions to the rule. You do not want to be buying into regional markets where their prices are being artificially inflated by the spruikers and the social media activity that's going on into those particular markets, because those price points will get way beyond their fair market value, and ultimately there will be a serious correction in those markets and you will be left with negative equity. I cannot stress that point hard enough in terms of thinking about the fundamentals of economic activity and the government running good economic policy to sustain land values in those areas. Because at the end of the day, it's the land value that matters, especially in entry-level locations. In the premium location, it's the land value that accelerates, but you also have the status and the exuberance that comes with signature properties and showpiece and trophy homes and all those other things that drive that premium end of the marketplace as well.
So lean into that just a little bit, folks, so we can really land the plane on that. There is an ability through social media and through movements that people have across this country to actually drive energy and attention into one particular location. And as a result of that, to Ben's point, the large amount of people will be investors. That will actually drive the price, but it's a pump and dump strategy, because what happens is the people who got in early usually enjoy that rise. It's a tradable market, not an investable market. And so that's the important point. So if you're trading, fine. You're playing a white knuckle ride, but you probably get it right if you know what you're doing. You probably get it wrong if you don't know what you're doing. But in terms of long-term fundamentals, is it an investable market? We would say no. So be thinking about, is it a 14-hour drive? Is it a 10-hour drive? Is it a 9-hour drive from a major capital city? Well, then your margin of safety, which we talk a lot about in our new book, Ben, that margin of safety doesn't exist for you. So it's fine when everyone's, and particularly the people who put you into those markets, usually get on social media and really start to gloat in the growth. But the growth has to be, A, sustainable, and B, largely, in our experience in watching these, it's the people who are getting you in that are benefiting the most.
And it preys on your human psychology in terms of, you think about behavioural economics. If someone's making a quick fortune over there, we all want to be a part of it.
FOMO.
So it's a self-fulfilling prophecy where you get irrational exuberance and an irrational behaviour, and then ultimately after that, you see who's been swimming naked when the tide goes out. So that is one of our big messages here in terms of, if you are looking at regional markets, the fundamentals of those regional markets can't be driven by the growth. The short-term growth can't be driven by these property buyers coming in who are investors. If you're a bank of investors, and how do you solve that problem? Just ring up all the agents and say, okay, how many properties have you sold recently? How many offers have you had on those properties? What number of offers were by investors versus owner-occupiers? That'll solve your answer, and then move on to your next town if you're thinking about those regional towns. This is the same principles that we see in fundamental investing, whether you're a growth investor or whether you're a value investor. Value investors think in the decades, growth investors think in picking a market and timing that market. It is a white knuckle ride, and if you get one of those markets wrong in the property space, you lose a lot of money and you lose a lot of time. because you'll have negative equity in those particular markets if you time it poorly. So it really is an important message around that. And that is through the rise of these spruikers and these social media commentators. And they will tease you 37% growth in X number of months, and that's how they suck you in terms of their messaging around.
Well, to your point, Ben, history teaches us a lot, right? So we'll put a link in the show notes for this episode. But we interviewed an agent, remember, in the north of Western Australia, maybe a couple hundred episodes ago, talking about what you just described. So if you want to see a historical precedent of the very thing Ben just spoke about, go and check out that episode.
All right, so there we go in terms of that's the base case and all of the derailers that we're thinking about and the sort of things that will influence the market, whether it's artificial inflation in the short term versus, as I said, value investing is about investing over long term with the margin of safety that we were talking about before. So if you haven't listened to our predictions or our Outlook show in 2024, we actually unpack a framework in which we work through, including our water wheel. Go and listen to that. And then also start to think about how we look at it. So we're not going to do that in today's show because we've already covered that ground. But we're going to start with the supply story first. And so when we look at the supply story, we're going to take a look at in terms of stock in market and basically how well that stock is being absorbed, right? So it's all well and good if listings are coming in really quickly, but if that listing is being absorbed also quickly, then you've got underlying demand as part of that particular story. So the first chart we want to basically look at is that listing story. Okay, so when we look at the listings, and thanks to our good friends at CoreLogic here, we can see here that we've got movements over the new listings, and right across most markets in Australia, we're seeing new listings are lower than what they were over the previous last year. So that is a good sign in terms of that's not new supply coming onto the market. When we look at the total change in the last 12 months, we can see there that Melbourne has had a 3% increase in the total number of listings. Adelaide is down almost 10%. Perth has now started to put more, and if you've listened to us for the 10 years, you will also hear us talk about that normally what happens at a midpoint to the top range of the cycle is that more listings will come on because people have been waiting, going, I'm just going to wait at the property. And then all of a sudden they realize, actually, a price is, maybe I really will sell now, right? Thinking they're trying to time the top of the market. So you normally do get a little bit of extra supply coming in at that particular point. Hobart, some good news there for them. Listings overall is down around 5%. And that was the big problem in 23, 22 when we were talking. They had a ton of listings. Darwin here, now again, small capital city, not big numbers, but their listing numbers are down 36%. Now, last year I told you that they are the smoky market that I was talking about, and I think that's going to come into play here. But what we were just talking about is really important. That is absolutely a trading market. It's a speculative market. It is not a value-based market. So as much as I'm predicting that Darwin will finish top, if not top two, in terms of the price growth over the next 12 months, you've got to be very careful about what strategy you're taking into that Darwin market. You've got to take a trading strategy into that market, not a buy-hold strategy into that market, because the fundamentals just don't support that for the long term in terms of decades.
You got that with Hobart, Ben, the same deal. People were taking investing strategies into a market that needed to be a trading strategy because everyone's saying, look, we did really well in Hobart, and that's fine. And we've got people that come on our podcast and say, look, we bought a lot of stuff in Hobart.
And
so we're not saying that you can't do well, but what we're just saying is if you're a first-time investor or you're new to the game, you don't want to be spending a lot of your time and energy on trading markets when you want to be in investing markets. They come from the 5 mainland capital cities. Number 6 population growth is the Gold Coast. They are in advance of Darwin and Hobart, even though they get the headlines of being a capital city.
Yeah, so, and obviously we saw Canberra's numbers there where their supply is up around 9%. So that, again, puts pressure in terms of overall supply when it comes to that. So what I'm doing now is we want to show you, in terms of our own research here, we've got all of this research and you can see the different changes in the different markets. So you can see where Darwin has made a significant look at that stock on market basically coming down into the realms of the other particular markets. So that is obviously one of those earlier indicators in terms of what that particular market looks like. So if I was to, sort of have a look at these particular markets, you can see basically what's happening. Okay, so I'm just sort of removing these other markets so you get a bit of a sense of that. Sorry, my computer froze for a second. So you can see, we're looking now at Adelaide. We're looking at obviously at Brisbane in terms of, so there's Adelaide. So really tight market still in Adelaide. Brisbane market, you can see those trends over the last couple of years. And then this is what I was saying before. The reason why Darwin has underperformed the last couple of years, but is finally turning the corner, is you can see basically the yield has actually gone to 6.7% from 6.5 12 months ago. So it makes a bit of sense in terms of why people would be looking at that particular market as part of that particular story. Now, the other thing we also then want to look at is dwelling approval. So we've just had a look at the existing supply in market. Now we want to basically have a look at the new arrival. What we predict is basically what's going to come into the market. So we can see here what's been also pushing prices higher is the supply story. So the government wanted 240,000 houses built every year to reach their 1.2 million target that they set 5 years ago. They were miles off it. 170,000 new dwellings were approved last year. So there's a big problem in terms of getting those approvals done. And if we don't have a plan to build them, we can't build them. So you see here that the unit market has basically been dead. We also know that the cost of building, we saw that through Tim at the Housing Industry Association, talk about the price of building a new dwelling has increased, and that's a home, by 47% since 2019. So this is also why it's a challenge. So as investors, this is an opportunity for us. We know that this supply is going to take a bit of time to come into the market, and that's going to mean that there's going to be pressure in terms of short-term price growth in that particular market. So what we then want to look at is, okay, the absorption. So we've seen listings, we've seen approvals coming through, and then we're now starting to see sales activity. And what we have seen is sales activity has picked up. It's still a little bit lower, like, during when interest rates were really low, our sales activity was off the charts. Everyone could afford to buy, so there was a lot of volume of transactions going on. This year has been a solid year, so you can see in terms of the national average, 6.7% growth, and then you can see what's happening in the different markets. So this is where, again, that absorption story. So Canberra's had a pretty good time of moving around 11% of their stock. Darwin's moved 26% of the stock. Another reason why Darwin has got a compelling story. You can see there Hobart, not a lot of buyer interest there because basically it's negative 0.8 of 1%. Then you've got Perth, Adelaide, Brisbane, Melbourne. So there's a bit of buyer's interest there. And I talked to you earlier about where the Melbourne story came from. That's firsties having a play in the marketplace whilst they were competing with less potential buyers. So that tells a pretty good story in terms of that. And then finally, we look at where that demand's coming from. We don't have this by state, so we're looking at a macro level here, but we can see here that it's trending upwards for both owner-occupier buyers, but you can also see that investors, whereas the long-term 5-year average has been around 33% of activity is coming from investors, we're up to 38.3. So what we're seeing is this new wave in terms of the Gen Xers who are coming through, who are now starting to think about their future. So the Gen Xers are now in their mid-30s, right? And so ultimately they've got their family home, they've got their family started.
Gen Ys.
And they're starting to move into this idea of thinking about their future and building some wealth. And so that cohort is the biggest cohort in the population series that we've currently got in Australia. So we're starting to see a lot of them starting to buy their first investment property. But because of the macro prudential and all of the borrowing power limits, guess where they're buying, Bryce? They're buying in those affordable areas. And that's why all of that demand has been driven into those affordable areas. All right, so that rounds out the, in terms of the stock on market for purchase. We're still looking at supply side. And so now what we want to do is we want to go and have a look at the rental supply. So here we are going back into our research tool here, and we can see what's happening with yields and then effectively what's also happening with rents. So let me just open up our rental yield story. And so we can see here the main outlier is that Darwin story. We also then have Perth. So the great news story for investors in Perth is they haven't had to sacrifice a lot of yield and they've still got a lot of growth. And again, that's off the back of a strong economy brings migration for jobs, and then they want to settle down.
Second highest median income in the country.
Yeah, so it's only natural in terms of why people are going to be attracted to that particular market. Then you've got Hobart. Hobart's yield is a product of their falling prices. So those prices are off double digits since their peak. So that obviously affects their yield in terms of how we calculate that. Then we've got sort of Brisbane and also Adelaide in this cluster. And then you've got Melbourne, and then ultimately you've got the Sydney story here. But if you look at, let's go and have just a look at rents. All right, now, so what we look at when we talk about median rents, there's an interesting story in this median rents, right? So you can see the cost. This is basically the average median rent that's being median, not average, median rent that's basically being charged in each of the capital cities. So Sydney's got the highest rent, followed by Perth with the second highest. Then you've got Darwin. Then you're coming down into Brisbane at 623. Then you've ultimately got Adelaide at 598. Then you've got Melbourne. And that's an outlier for me. Melbourne's rents are around 10, and this is the research that I've been doing, they're about 10 to 15% off the East Coast. So if I go a similar distance from the city and I look at similar types of properties from the central business district, Melbourne rent prices are 10 to 15% lower than where they need to be. So if you own an investment property in Melbourne, you need to jump onto More and you need to do the asking rental analysis tool that we've got in there. And you need to take that to your property manager and you need to say, I think our rents can go higher. So even if the property manager says, I'm not quite sure, you've got evidence-based data that can support you in terms of making sure that those rents are higher in the Melbourne market. There's no reason why those rents shouldn't be moving at a market rate in terms of what's happening in those areas, especially when you've got 26,000 less rental properties in the Victorian market, thanks to the regulation that's been put into that particular state. That's what we always said. If you throttle the market, the unintended consequences are that rents will go higher. And so you need to start moving those rents higher if you're operating in that Melbourne market. And then finally, the last bit of data here is I'm trying to get it to pick up. There we go, Hobart market. And that makes sense because it's got one of the lowest incomes compared to the other capital cities. So we're starting to get a bit of a picture here around supply, right, in terms of what's actually happening here. So let's now move into starting to talk about what's going to be happening on the demand side, right? So this is where, ultimately we want the market to be out of equilibrium. And by being out of equilibrium, that's when we get an opportunity for future short-term capital growth. So on the demand side, we've still got APRA driving investors into that affordable markets. We don't have any fears of job anxieties like we did last year. We don't have any forced sales. The higher employment story meant that we don't have mortgage in possession sales, which people were talking about the risk. And
so Ben, that's no forced sales through COVID, no forced sales through mortgage cliff, no forced sales through 13.
What about the fixed rate cliff? That everyone, that was 2 years ago now. Time flies, right? 18 months ago, everyone was talking about this fixed rate cliff. Never happened. We were telling you it's not going to happen. It's too widely spread.
Now, no Y2K either. So it's just racking up headlines here that people will just get anxiety around that doesn't need
Follow the logic. Okay, so then we've got household formations. That has definitely made an impact. So we are starting to see when rents are getting more expensive, people are forming sort of a flat share type arrangements. That's all pretty good in terms of adjusting for the demand and the economic mechanisms that happen inside a marketplace. We are going to see a bit of slowing migration and immigration. So I think from that point of view, that's an important story that we need to understand. The government interference, again, obviously the Greens are doing a great job of scaremongering in the rental market. And so ultimately, if they keep doing that, that'll continue to play with market sentiment and potentially impact the people that they are meant to care about, being the renters. The upside story is what we've just talked about. The cost of building new homes is so expensive at the moment. So the supply side is not going to come on quickly. certainly not in the next 12 to 18 months, but after that, hopefully it'll start to settle down as that demand for labour and unemployment goes a little bit higher. We'll see those labour costs come down and hopefully some of the material costs come down as well. Then we've got interest rates, which is a good news story for us. Obviously, lower interest rates, when interest rates move by 1%, it usually means about a 6% movement in house prices more globally across the country. Inflation is falling, which is a good news story, and real wages growth is growing at around that sort of 3% range. So that also means that borrowing power is actually meaning that you can borrow a little bit more, and that puts upward pressure on prices over the longer term. So in terms of looking at the data that we want to do from a demand point of view, let's go back into our research tool again. And so we'll start with looking at some of these data points. So we obviously always measure demand supply score. And as part of that demand supply score, we're looking at around 17 variables in terms of what's happening in those markets. And usually when you've got markets that are sitting in the high 50s to early 60s as a broader market, they're in pretty good shape. Now, what we can see here is we've got Melbourne sitting at 62. So that's to the point that I don't care if oranges are, out of season. I want to buy them. I'll buy them, and that'll put pressure on prices. So that's what we're seeing now in terms of what will happen, what we predict will happen in the Melbourne market. You can see the Sydney market number has come off quite considerably early. So that will be an affordability challenge story in terms of what happens in that particular market, in terms of whether there's going to be enough demand. When we go and have a look at some of these other markets, so I'll go and quickly have a look around the grounds. So that's what I was saying about Sydney. Let's have a look now at Adelaide, and we can see here that Adelaide is also starting to cool off, but still reasonably good numbers when you're looking at the entire metropolitan area. Brisbane is starting to also cool off a little bit. So where does that sit in its cycle? Then you've got Darwin, again, coming off a horrible low bottom, but starting to increase in the right direction. Then you've got Hobart, again, sort of not in a growth phase in our view. Then you've got Perth, which was also sitting very, very strong. And then, as I was saying before, there's the Sydney market coming off its greater peak. So that's the first thing that we look at. So after we look on the demand supply ratio, we want to look at things like days on market, right? So we want to try and see what's basically happening in terms of how long, and this is that absorption story that we were talking before about. And so when we open up the days on market, we can actually see quite an interesting story here. So what you've got here, we'll sort of unpack it again by different marketplaces here so you can see what's sort of happening. So let's start with Sydney, our biggest market. You can see that we're starting to see an uplift in terms of days on market. Now, this is pre the rate cut, so we want to see basically what happens after that. Then we've got, look at the Perth market, still a really strong story from, you can see that run down, which has obviously meant the property price growth has also occurred. You've got days on market in Melbourne that's sort of sitting, again, pretty flat, but was obviously on the uptick. That's why property prices were going higher. And then you've got Hobart sitting at a high point there as well. Now, Darwin's an interesting one. This one is definitely an outlier. I don't want to spend too much time talking about it because it's a trading market. But what we think is occurring here is we're measuring when listings are up and when they're taken down. There's not a lot of listings. There's about 130 listings in Adelaide, in Darwin at the moment. So I reckon those real estate agents just leave them up there just because they create traffic. So I don't think this is necessarily a reliable indicator on that one for mine. And then we've got, obviously, let's bring Canberra into the equation. So you can see Canberra sitting again higher and increasing. Then you've got the Brisbane market, which is still tight. So we still see growth in Brisbane and we still see growth in Perth. And then, as we're talking about in terms of Adelaide, we still see it, scratching out some growth. But in terms of the level of growth that we're going to see in those markets is definitely going to be something that we want to think about. So the other important thing that we're trying to also look around is the cyclical timing of different markets. And we use market cycle timing as one of those mechanisms in terms of what produces that story. So let's start with Sydney. So the higher this score, the better it is in terms of where it might potentially go in terms of the next cycle. So then we've got Perth coming in. So you can see, the market cycle timing was really high here, and that builds up off the back of sluggish performance. So it's sort of a reverse view. So when you've got low growth over a long period of time, the market cycle timing says, well, that's got to be closer to its next cycle of growth. So it's a reverse view in terms of what it looks like. Then we got Melbourne that's kicking in here. It's obviously been relatively flat. It hasn't had static performance, but it hasn't obviously had any great performance. Then we roll over on Hobart. Again, Hobart had, that sort of growth run through here, so that's why it's in reverse, and it's now starting to build up because it's obviously lost all of that value through that period. And then you've got Darwin. So I'm going to start taking a couple of these out so it's a little bit easy to see. But you can then start to see Darwin's building up strongly in terms of what that story looks like. So, it's the highest reading out of all of them. Then you've got Canberra, which has also, again, come through a period but sitting around the middle. And then you've got Brisbane. It's had strong growth, and that's why it's sort of saying this cycle can't continue to keep going forever, but it's still not in dangerous territory in terms of how far it's slowing down. And then you've got Adelaide in a similar story because it's had, that wonderful 2 or 3 years of steady and consistent growth in terms of that. So these are all the things you want to be thinking about when it comes to looking at the demand picture. So we've given you a sample of some of the important things that you want to be looking at in terms of the demand side. There are other things that you want to be thinking about, and you want to be tracking those at the state level. And if you're thinking about regional markets, similar type of story. Just watch the total stock, see where that's moving, watch the days on market, watch the average vendor discounts, look at those types of things as forming part of that particular story. So I thought we'd just close by just looking at the accumulative growth that's been enjoyed over that last 3-year period across all of our capital city markets. So you can see here that the Adelaide market has had a really terrific run over that time period, as has the Brisbane market, as has the Perth market. We still think that there's still some growth to be had, certainly in the Brisbane and the Perth market, going back to their economic fundamentals. Okay, they haven't grown as much as what Adelaide has, so we're thinking that they still have some more sting or more opportunity in terms of price growth. Let's go down and have a look at a couple of these other markets now as we move across what have been the prime performers. And then we can see that really a lot of these other markets have been treading water over this particular period of time. So when we have a look at the Canberra market, you can see it's been sluggish. Then we have a look at the Darwin market. It's finally starting to show that price growth that I've been talking about. Then if you have a look at Hobart, again, it's off its peaks and it still remains off its previous peaks. And then we've got the Melbourne market. So we'll take a couple of these out again. And then you can start seeing the Melbourne market has been the underperformer, certainly over the last 3 to 4 years, off the back of what we were talking before about. So there's a wrap up of some of the demand factors that you'll be looking at. The other things you want to potentially be exploring, as we were talking about, is days on market, stock on market, average vendor discounts. Those types of things are telling part of that demand story, as well as that market cycle timing sort of piece. So I wanted to just wrap up the story by sort of showing you the last 3 years of performance. So remember, properties can, and like any sort of thing, from a demand, supply, and an economics point of view, they can never always be out of equilibrium. At some point in time, they will move back into equilibrium where demand will push and bring up to that particular level, or supply will arrive and bring prices down to an equilibrium. So that's why these cycles only happen in spurts, and it's not a beautiful linear line over the longer term. So when we think about the top performing markets, so I'll just highlight those, sort of top performing markets. And you can see these are the top performing markets over that time period. So I'll take Sydney out. And so you can see here and I'm taking Canberra out. So these were the 3 big markets that shot the lights out. Adelaide has had a stronger run over a longer period of time. Then you've also got Brisbane that's also been doing quite well. And then obviously the strong performer over the last sort of 12 to 18 months has really been that Perth market in terms of when we're looking at that data. So when we then take those markets out, we can start to see that most of the other markets, such as Canberra, Hobart, Darwin, have been treading water. But you can see that Darwin is finally starting to move in an upward direction after being the perennial underperformer since about sort of 2015, 2016. In fact, Darwin was the best performing market in the 2000 to 2010 decade, if my memory serves me correctly. And then the other market that we want to be looking at is obviously the Melbourne market. So, and then the Sydney market. So our 2 big capital city markets, we can see that, Sydney has scratched out some growth over that time period. And when I say scratched out, it's about 40%, in terms 41%, whereas Melbourne has really struggled in terms of maintaining that growth over that 3-year particular period. So how I'd wrap that story up in terms of bringing all of those markets into play, one of the things we want to be talking about is more broadly, we don't think that there's going to be strong price growth across all markets over this 2025 year. We think it hopefully will be a little bit more steady and a bit more sustained as part of that. But again, the markets in market story, we think that the market that will perform well will be the affordable markets based on borrowing power and how the government have got those macro-prudential regulations in place. I think we will start to see in the premium end of the market some growth in those markets that have been flat over a reasonable period of time. So we are on the positive ledger in terms of price growth across most of those particular markets. We think that Hobart will continue to be challenged. We think that Sydney, from an affordability point of view, will continue to be challenged. So we expect continued growth in southeast Queensland. We expect some of the regional centres that are going to have these irrational amateurs playing in them off the back of spruikers will probably be the better performers this year, but it won't be sustainable performance. So we don't, that's trading markets, so we won't be touching that. And we put Darwin in that category as well. So even though we think Darwin will be the top 1 or 2 in terms of performing, we've got to think about your strategy. You've got to think about what vehicle you're using to buy those properties in. So for mine, and this is my own personal opinion, this is not advice, if you've got a self-managed super fund and you're looking to trade a market because you only have a 10% capital gain because you're going to sell, this is not a buy-hold strategy, that would be the type of vehicle that I'll be using to go into those types of markets, especially with their attractive yields. But that is not a value play, that is a trading play as part of how we wrap this up.
So here we go, folks. Now, just to give you a bit of an insight, 2 things. One, Ben loves the data. So you could obviously realise for the last hour or so that he loves the data. Second, he's sweating, and he doesn't normally sweat, right? So so we'll take it down to one thing, and that's because he's passionate about what he's just shared with you. So let's wrap up some of this. Let's summarise one. So first of all, a headline level, inflation is looking like it's going in the direction that we've wanted it to go for the last couple of years. So that's a tick. Growth, Ben just did a wrap around where that's looking, in terms of probably no standout headline performance this year. So therefore, a lot of the detail is getting underneath the headlines and getting into the field and actually finding where those markets within markets are. And that really is a skill. We're in an election year, all right? So we don't know how many interest rate movements we are expecting. We've predicted another couple. Timing, is it before the election for the next one? Is it after the election for the next one? That remains to be seen, with another interest rate movement likely to happen towards the end of the year. In terms of sentiment, you can see there's a disparity between people think that properties will continue to grow, but right now, are we thinking that we will dip our toes into the water now? I think what you're seeing is really a market that's fully exhausted the resources that are available to it. Last year, we said that there was price movement, despite the fact that we probably didn't think there was. We're probably starting now to move into glass ceilings in a lot of markets, largely because borrowing capacities are being maxed out and people are borderless investing. And we've got a few people who are pushing people into enthusiastic amateurs into certain regions.
More speculative locations.
Don't make the
fundamental long-term growth story. Yep.
But in summary, folks, here's what we're saying to you. If you are playing a game to set up a passive income that provides you a retirement in 5, 10, 15, 20 years from now, I'll go back to the original conversation that I said to you at the very beginning of this podcast, is largely what we're talking about is irrelevant, with the exception of where you actually start, which market you actually put your property into, because nothing's changed, folks, and this will be no surprise to our long-term listeners. Buy the right property, correctly finance and hold it for the long term is still relevant with a property market outlook today, as it is in every episode that we talk about. So, folks, hopefully that's given you some confidence, some data to underpin that overall the property market in this country is strong. Largely speaking, we've got more people who want to live in a house than we have available. So if you apply some science and play a long-term game, you should be looking pretty good. But make no mistake, our prediction is that there's no standout outlier performance this year, with maybe the exception of some of those trading markets.
Yep.
That we don't suggest that if you follow our plan that you
So some regional markets will deliver double-digit growth. That's a given. But again, be very careful about where they are. To Bryce's point, try and get them in commutable distance to major cities for long-term sustainable growth. If we were to put them into the buckets, as I said to you, I'll put Darwin in my top 2. I believe that Adelaide will come down. They will finally, and Perth's rate of growth will slow down. Queensland, Southeast Queensland will continue to do well, but also be in that sort of growth bucket. And then the one that will come up is actually Melbourne. So Melbourne is going to come up just off the investor demand from the interstate buyers in terms of that. So we know that a lot of buyers agents are getting on planes and coming down here. So we know that that's creating this heightened level of demand in the short term. So if that was to continue and people start to see growth in Melbourne, then we believe Melbourne will do that. Now, from the fundamentals, we think it's a little early, but again, it's counter-cyclical investing. If you're investing for the long term, what Bryce was saying, then Melbourne should always be an asset that you want to hold in your portfolio. Then you've got Canberra, which is uninvestable. There is just no incentive to invest in Canberra at all. So if you are thinking about the Canberra market, go over the border into Queanbeyan, because obviously that's in New South Wales and you get New South Wales regulations instead of Canberra regulations. There is so many problems with being an investor in that particular market. I won't bore you with them, but you just don't get any return on your investment there. So I've wrapped them up. And Sydney probably in the bottom of the 8. So I've got Sydney in the lower end. I've got Hobart there. I've got Canberra down in that bottom quartile. Then we've got, as I said to you, I've got Darwin as number 1. I've got probably Brisbane and Perth in that sort of fighting for 2 and 3. Then I've got Adelaide coming down and Melbourne coming up in terms of what they look like in this. Again, these are just predictions. I'm putting my views out there. But to Bryce's point, I'm really thinking about these from a long point of view. If you ask me, you put me on the spot to give me that ranking, that's what I've just given you in terms of where I see the market.
Because ultimately, at the end of the day, we're just trying to get people to take action. And this stuff matters, and people will click into this with some form of hope about where they should put their money. So we get the short-term stuff, but ultimately we're going for the long-term stuff.
Correct.
So
beautiful.
Well said. Hey, my life hack today, Ben, is largely, I've tried to think about something. How do I, the Mindset Minute was around the giraffe to try and set the scene for what we're doing here. So my life hack today is it's around perception versus perspective, and it's a spy secret. Andrew Bustamante, I hope I got that right. He's a former CIA intelligence officer, and he was asked on the Lex Fridman show, what is the one spy trick you would teach everyone that they can use to improve their life instantly? And I think it relates to what we've just been chatting about. So let's have a little listen to that now.
What is the one spy trick you would teach everyone that they can use to improve their life instantly?
The most important spy trick to change everything immediately is something called perception versus perspective. We all look at the world through our own perception, but perception is your interpretation of the world around you, but it's unique only to you. There's no advantage in your perception. That's why so many people find themselves arguing all the time, trying to convince other people of their own perception. The way that you win any argument, the way that you get ahead in your career, the way that you outsell or outrace anybody is when you move off of perception and move into perspective. When you shift places and get out of your own perception and into someone else's perspective, now you're thinking like them, which is giving you an informational advantage. But you know what they're all doing? Everyone else out there is trapped in their own perception, not thinking about a different perspective. So immediately you have superior information, superior positioning. You have an advantage that they don't have. And if you do that to your boss, it's going to change your career. If you do that to your spouse, it's going to change your marriage. If you do that to your kids, it's going to change your family legacy because nobody else out there is doing it.
All right. So how does that apply to what we just talked about, Ben? perception versus perspective. He said the number one thing you can do is everyone has their own perception of what's going on, but that doesn't serve anyone. What you need to do is actually shelve your perception because that's unique to you and actually step into someone else's perspective. And he says, if you actually apply that he said it in that piece. If you do that to your boss, it'll change your career. If you do that to your spouse, it'll change your marriage. If you do that to kids, it'll change your family legacy. And I'm going to say, if you do that to your investing paradigm, it's going to change your results. Because here's what we hope that we've actually done today is that based on your experience and the filters and everything that you've come across to come to a conclusion about whether 2025 is actually a year that you should be investing, we're actually hoping that you can shelve your perception, put that aside, and then take on board the perspective of someone like you and me who have been doing this now. We're entering our third decade and we've seen lots of cycles and we've seen lots of stuff that's happened. Yep. So if you can take on board our perspective, hopefully, and then we're encouraging you to take on as many perspectives as you possibly can. Yep. But ultimately, if you are a believer in our movement, in our community, if you can take on our perspective and see what we've just spent the last hour or so bringing to you, hopefully that will actually serve you. And if you remember the very last statement that you heard in that clip, it says, because nobody else out there is doing it. And that is one of the reasons why so few people actually invest in property. And for those of us who actually do, I promise you we still have thoughts and anxieties and insecurities about whether we're making the right decisions and we're putting people in the right spots. But ultimately, you take the perspective of the giraffe. You then have the ability to shelve your perception and look through someone else's perspective.
Well said, mate. Beautifully summarised.
That will serve you. And at this point is where I normally say, Ben, what's making property news? But folks, I don't know if you noticed, we just spent an hour talking about that. So
that's the property news.
So there we go. But mate, hopefully that has served our community. Folks, if it has, we would love for you to share, like, do whatever it takes to help us.
Give us your own feedback. What's your predictions in the YouTube channel? Give us a little rip in terms of what you're thinking yourself and put your case forward because we're always learning as well. Yeah. I want to see what your case is. What's your argument in terms of why you think certain markets are going to perform over their other markets? I will read them all.
And what's the baseline for your thesis as well? So, hey, well done, Ben. That was fabulous, folks. We are ready to rip into another wonderful year. We've also got an incredible economist coming up, Ben.
10 years. Woo!
10th-year anniversary. Looking very good for you there. But hey, until next week, Ben.
Knowledge is empowering, but only if you act on it.
See you next week, folks.